Welcome. Today, we are going to pull back the curtain on one of the most critical documents in all of real estate investing. Seriously, it's the key to unlocking a property's true financial story. You could even call it its financial DNA. So let's get right into it.
So, have you ever wondered how the big players decide to drop millions, sometimes hundreds of millions of dollars on a single building? I mean, how do they know it's a good bet? Do they have some kind of crystal ball that lets them see into the future? Well, kinda. In a way they do.
And this right here is that crystal ball. This quote says everything you need to know. When you're talking about major, high-stakes real estate deals, the rent roll isn't just some piece of paperwork. Nope, it is the single most important document they look at. It's where the truth lives.
Okay, so what is a rent roll exactly? Well, think of it like the financial blueprint for the entire building. It's a super detailed report that lists out every single lease. It tells you exactly how much money is coming in right now, what the hidden risks are, and, maybe most importantly, what the future potential for growth looks like.
So here's our game plan. First, we'll cover how to measure a property's health, its vital signs, if you will. Then we're going to get into the nitty-gritty and read the fine print. After that, we'll put on our detective hats and learn how to spot the hidden risks. And finally, we'll see how you take all that data and turn it into a smart investment call. All right, first things first, let's talk about the vital signs. These are the big picture numbers you look at right away to get a quick pulse check on a property and see if it's even healthy enough to consider. You know, there's a huge difference between a building that seems full and a building that's actually making money. Physical occupancy, well, that just tells you if there's a body in the seat, so to speak. But economic occupancy, that tells you if they're actually paying their rent. If you see a building that's 95% physically occupied but only 80% economically occupied, that is a massive red flag. Now this is where investors really start to hunt for opportunity. You look at the in-place rent, what tenants are paying right now, and compare it to the market rent, what you could get for that same space today. If the in-place rent is lower, bingo, that's your upside. But if it's higher, oof, that's a huge risk because your income is likely going to go down. Next up, we've got WALT. It stands for Weighted Average Lease Term. Sounds a little technical, I know, but the idea is actually simple. It's the average time left on all the leases in the building. And the weighted part just means that the bigger tenants, the ones paying more rent, have a bigger impact on the final number. It's a really powerful way to see how stable the income is. And here's why that matters so much. A long WALT, it's like having a guaranteed contract for your income stream for years to come. That means predictable cash flow, less risk, and let me tell you, lenders absolutely love to see that. A short WALT, on the other hand, just means you've got a whole lot of uncertainty coming your way, and fast. Okay, so we've checked the vital signs, we've got the big picture, now it's time to go a level deeper. We're moving on to reading the fine print, which is where the real story of the property starts to come out.
Just take a look at this chart. This is a classic textbook example of risk. You see that huge slice of the pie? Tenant A is paying 45% of the entire building's rent. Now ask yourself, what happens if tenant A decides not to renew their lease? Boom, almost half of your income disappears. Just like that. That's tenant concentration risk, and it can be a deal killer. Another huge detail buried in the fine print is who pays the bills. With a gross lease, the landlord is on the hook for pretty much everything. Taxes, insurance, maintenance, that's high risk for the investor. But on the flip side, you've got a triple net or NNN lease, where the tenant pays for all that stuff. That's way lower risk for the landlord. And of course, there's modified gross, which is somewhere in the middle.
You know, smart investors are always looking for built-in automatic growth. The best leases have what are called rent escalations, which are just annual rent bumps. They can be a fixed amount, like 3% a year, or even better, they can be tied to inflation. A lease with no increases, a flat lease, is a real problem. With inflation, that means your money is actually worth less and less every single year. All right, now for my favorite part, the detective work. This is where you really have to put on your investigator hat and scan that rent roll for the subtle clues, the little red flags that could totally sink what looks like a good deal on the surface. And look at this chart. This is probably the biggest hidden risk of them all, rollover risk. Check out year 2. More than half the entire building, 55%, is up for renewal in one single year. That is a terrifying situation. You could be facing a massive vacancy, huge costs to find the tenants, and a major cash flow problem all at the exact same time. And here are a few more of those critical red flags you need to be hunting for. We talked about clustered expirations and tenant concentration, but also look for things like a ton of free rent being given away. That signals a weak landlord. And in retail, watch out for dark space. That's when a store has closed down, but the company is still paying the rent. It's a pretty clear sign they have zero intention of renewing that lease.
So, you've checked the vitals, you've read the fine print, you've done the detective work, you understand the whole picture. The very last step is to take all this information and use it to make a final call. And this is the playbook the pros use, every single time. First, verify everything. Don't just trust the summary, get your hands on the actual legal lease documents and make sure they match. Second, build a model to forecast your cash flows. Third, calculate the true effective rent, which is what you're actually collecting after you account for things like free months. And finally, stress test your deal. Run a simulation. What happens if your biggest tenant walks? A good deal needs to be able to handle that pressure.
So you see, the rent roll isn't just a spreadsheet. It transforms a pile of bricks and mortar into a living, breathing financial story. It tells you its past, its present, and its future. So the only question left is, now that you know how to read that story, what are the first secrets you're going to go looking for?